Chapter 20 Math. Let's review it. First of all, you're going to need to know about common areas. You'll need to know how to do the cost depreciation approach. You'll need to know how to do the income capitalization approach. You'll need to know how to do the gross rent multiplier, how to calculate the profit percent, how to amortize a loan. You'll have to know how to do a commission. You'll have to do a rent proration and a tax proration, and you'll have to be able to do the transfer taxes. That's your dock stamps and intangible tax. Here is a good example of a cost per acre and a cost per front foot. This is out of your textbook, and all you're doing is you're trying to figure out what is the total acreage or total square footage that I'm going to be able to develop on. In this particular case, all you're going to be doing, here's your calculations. If you've got 20 acres, you're going to multiply that times the number of square feet in an acre. Then you're going to subtract out all of those things that you cannot develop on. And once you've done that, you simply divide it by the number of square feet that you're using as your footprint on the development. Remember, you cannot have a short. You always round down and not round up. In terms of acres, there's 640 acres in a section. So how many acres are there in certain sections? The example here, the northeast 1/4 or the northwest 1/4 or the southwest 1/4, all you're going to do is take 640 and divide by the bottom numbers. That's all you do. But I want you to be mindful of the word "and," because the word "and" means there's more than one legal description. You have to separate them and then add them together once you've done your calculation. You'll have to be able to do the cost depreciation approach. And what you're going to be doing in the cost depreciation approach is determining the value of the property using the cost approach. And here's what we're going to do. We're going to determine reproduction cost. Then we're going to determine the accrued depreciation. And then we're going to subtract the depreciation from the reproduction cost. And that's going to tell us the depreciated value of the building. Then we add the land back into it, and that's going to give us our total depreciated value of the property. Reproduction cost minus depreciation plus the site gives you the depreciated value of the property. The income capitalization approach, remember we got to find net income. Potential gross income minus vacancy gives you effective income. Minus your operating expenses gives you net income. You take your net income divided by the cap rate, and that'll give you value. The gross rent multiplier, you're simply going to take the gross rent, and usually it's the gross monthly rent, times that multiplier is going to give you value. The percentage of profit, you're simply going to take what you made and divide it by what you paid. What you made is your net profit. What you paid is the original purchase price. Now, here is a loan amortization. You're going to take simply the loan amount times your annual interest rate. That'll give you your annual interest. Well, you make your mortgage payments monthly. So you'll want to divide that by 12, and that'll give you your monthly interest. Remember, your payment is made of principal and interest. So what you're going to do now is you're going to take your mortgage payment, which is principal and interest, minus the interest portion of that payment, and that's going to give you your principal pay down. Now you have a new loan balance, so you're going to take your old principal balance minus that principal pay down will give you a new loan balance. And you'll do the same steps over and over. Again, this is in your textbook. I recommend that you go back and look at it. In terms of calculating commission, here is a standard question that you're going to get. Broker Bob agrees to pay sales associate Sam 60% of a total commission. Sam sold a property for $375 and agreed upon a commission of 7.5%. They're asking what is Bob's share, not what is Sam's share. If Sam is getting 60%, Bob's getting 40%. And there's your calculation. 375 times 7.5% times 40% gives you the answer. Your prorations. Remember, a credit is money received, A debit is money that's owed. Happy face, sad face. Remember also in a proration, it'll be one amount of money that one person owes to another. It is never two amounts of money. If it's paid up front, you look to the rear. If it's paid in arrears, you look to the front of that timeline. You'll also need to know how to calculate your transfer taxes. Your documentary stamps on the deed, remember, 70 cents per unit of $100, and any fraction thereof you must round up. That's based on the purchase price. The intangible tax is based on the mortgage. It's 2 mils, 0.002 times all new debt. And that could either be the bank or it could be the seller financing. The doc stamp on the note or notes is 35 cents for every unit of $100 and any fraction rounded up. Now remember, this is based on new debt but also assumed debt, and let me explain. I mentioned earlier that anytime that a person assumes a debt, assumes a mortgage, that if you're going to take responsibility of the property by owning it, you've got to take responsibility of the debt as well. And the only way that you can become responsible for a debt is to sign a promissory note. The rules of thumb in closing are simple. The purchase price is always going to be a debit to the buyer and a credit to the seller. The earnest money deposit is going to be a credit to the buyer. Mortgages are always going to be a credit to the buyer and a debit to the seller. And that is the end of Chapter 20's Math Review. Once again, remember, math is only 10 points out of 100. Don't let it get to you.